Hey there, it's Chris Vermeulen from the Technical Wealth Advisor. I want to quickly walk you through the service of what this actually is and how it works and how it can benefit you. Now, more or less, I've been trading for 23 years, and this is the most simple to follow index and bond ETF trading strategy I think out there. It doesn't get much easier. I've been trying to hone in and find something that requires the fewest amount of trades while catching the biggest chunks of the market, catching significant trends and cycles in the market, and moving from that risk on to risk off asset class, which is the SP 500 and into bonds. So we're looking at there's all kinds of ETFs to trade around that. SP 500, you've got the 1 times, the 2 times, the 3 times leverage ETFs, depending on your comfort zone. And we've got we've got bond ETFs where you can add leverage as well, 1, 2, and 3 times, depending on your comfort zone. Now, more or less, this is a strategy that absolutely crushes the SP 500 in both bull and bear market times because we're not just trading equities to the long side, we're actually profiting from bonds rallying during times of uncertainty when the stock market trades sideways or pulls back. So you get this extra boost of gains when things go dormant and nervous in the market in terms of equities. And of course, this is designed for any individual trader, any advisor who's looking to try and get more alpha, help time the market with some of their clients or accounts, whatever it is. The whole point here is to just simplify your life, your portfolio, and grow your business, your assets using a strategy where everyone understands how bonds and equities work, and all we're doing is shifting from one to the other in a very slow manner. The average trade is around 42 days in length, so it's not active, but it creates a real powerful punch in terms of performance and very low drawdowns. Now let's jump into the charts real quick here. I'm going to try and make this video pretty short, as short as possible, but more or less, if we look at the market, we've got the SP 500 up top. You can see the big sell-off recently. This is February, and then we had the March crash. The blue line you're looking across here, this is the chart of TLT bonds. And so what we want to focus on here is simply when our system is green, we'll be long the SP 500 in most cases. Eventually, things will start to show uncertainty and that the market is weakening. And there's this underlying indicator in the bottom here that gives us market internals. This is gauging the market versus on volatility, cycle analysis, intermarket analysis with about 6 other different asset classes, how they're all performing with each other. And when they start to get worrisome here, when they start to change, they start to become favorable for the risk off. So we want to be long equities during this time, which we were. We were long equities right over here to this gap down, which a trailing stop took us out of a play for equities. But over here, we actually started to scale in. I think it was over here, we scaled into TLT when the system was showing that bonds were actually starting to perform really well. They had broken out of a long-term trend line that actually came across here. And of course, our system was saying, hey, money is moving into all these other asset classes slowly. They're worried that something in the market is going to happen. And so we rode bonds up and it went all the way up and we exited bonds somewhere over here on this big spike. And it was a 20.1% gain on our bond trade. And then our system moved to cash. There's all kinds of analysis that goes into this, but more or less we moved to cash at 20%. And from there on, the bond market crashed, the equities market crashed, everything collapsed, including gold, miners. There was no safe haven except for one simple asset class that people don't ever think is a position, and that is cash. You look at the price of UUP or just the US dollar in general, it rallied 11% while the stock market crashed. We were in cash during that time, so the only asset that actually went up across the board was cash, and that's what we were in. And that's the power of this system is we can play the benefit of the market. We can also start to move in and follow the coattails of big institutional money. When they see something coming, we can play that fear spike. And then we can also move to cash when our trailing stops, our statistical analysis says, hey, everything's out of whack, you need to move to cash. So let's go back in time and look at a couple of these other scenarios. Let's just go back. We'll go back to this point here. So more or less, we'll be coming out of another trend here. Once it goes orange, we get long. So we'd be long the SP 500. Now it's very squished down because I've got two charts squished on here. These are very nice moves in the market. And as the market rallies up, we're hitting profit targets. Our trailing stop will be trailing price up, and eventually the trend changes. And at that point, that's when we start to look to take on a risk off asset, which would be our underlying indicator down here, our market analysis indicator here. Bonds are breaking out. They've broken out of this channel. They're starting to move to the upside. And of course, we get long bonds, and bonds took off and had a very strong rally in price. Again, it's hard to see, but you look at the price here, more or less it went from about a buck 82 all the way up to somewhere to 205, 203 bucks, somewhere up there. And then eventually the market reversed. We got a new signal to get long equities. Equities took off, and bonds just flatlined more or less for the rest of that time. And so that's the power of being able to rotate. And if we go, let's just go forward here a little bit. If you go forward here, you can see similar type of scenario. This is eventually that trend rolled over, and our protective stop would have pulled us out of that play. And then, of course, bonds started to become in favor here, along with our market technicals starting to break down. Of course, bonds broke out, and bonds had this massive mega rally. And if you're trying to short equities in a bull market, typically you only get 1 or 2 down days, and then the market just chops and trades sideways. Very tough to short a market unless you're trying to pick market tops. You've got potential for some downside, but picking market tops is a loser's game. In the end, it never works out. You'll be net negative trying to pick tops and bottoms. So while the stock market traded sideways, bonds took off for a huge 15-20% rally. And then, of course, the trend, our systems picked up, hey, money has actually been loading up and getting into equities. We're starting to see things fizzle out. You can see in the market internals, they're changing. Bonds pulled back. Of course, we would have hit our targets. Our trailing stop would choke the price out eventually. But once we get confirming indicators, we exit bonds, we go into equities, and actually equities had a really nice rally. Again, this price is squished down, but we're hitting some of our profit targets on these rallies and pauses going forward. Of course, now not every single trade is going to work out. That's trading, and sometimes we get smaller moves in the market. And for example, over here, we get into bonds, and bonds had a little move up. We actually did hit our first target here, so our protective stop would have came at break even, take some profits off and get knocked out there. During this time, when you get knocked out until there's a new signal, we would just be sitting in cash waiting. And then you get a new signal to get long equities, and they take off, and the safe haven money kind of just fades back out of favor again. So that's how this system works. We're just rotating between equities, bonds, sometimes cash, and we're managing our position sizing. And sometimes we're going to have a mix of both of these assets. So sometimes we'll be long the equities, but when we start to get signs that the risk off assets like bonds are starting to outperform, we'll actually sell some of our equities and buy some bonds, and they'll actually kind of counter each other. They stabilize price of our portfolio while the market becomes more choppy and uncertain, and eventually we'll be moving in one of those two asset classes when we get follow through of a new potential trend reversal or a continuation trend that's already in place. Hopefully that gives you some insight of what we're doing. Really straightforward strategy, but it's taken years to refine and get the market timing down. There's a lot of analysis that goes into this, and the robots are constantly updating every 30 minutes what's going on. So hopefully you're going to enjoy it. I mean, this is my my kind of dream system that I've built, and it just continues to get better every year as I refine and learn even more. Anyways, take care. Bye-bye.